Well, thank you. I'm really thrilled to be here because I'm at a stage in my life. I'm 70 years old, and I'm at a stage in my life which I sort of describe as the transition between the second phase and the third phase, in which my goal is to pass along whatever I've learned that has been helpful to other people. I think life basically operates in three phases. The first phase is you're dependent on others and you're learning. Second phase, you're working and others become dependent on you, trying to be successful. And then in third phase, you want to make this transition. You're no longer interested in being successful. The best thing you can do is pass along what is, maybe help other people be successful, because it's a journey. In my particular case, I fell in love with the markets when I was a kid, when I was about 12 years old. I was caddying, and then I got my caddying money and I started to play the markets. I'm a global macro investor. So I have to bet on economics as it becomes manifested in prices in the markets. So that's what I do. That's my game, and I love it. And over a period of time, I went through a whole bunch of experiences that were, eye-opening experiences. Most valuably, the mistakes. One of the great things about the markets is it's not easy to beat the markets. And there's a consensus out there that's captured in the markets. And so it makes understanding of economics very practical, because I get a scorecard. And based on that scorecard, and also positive and negative reinforcement of the pain of losing and so on, I then learn. And I learned that many of the things that I was surprised about were things that never happened in my lifetime before. And that's why I was surprised, but that they happened before. The first time I was clerking on the floor of the New York Stock Exchange in 1971, and nobody was accepting dollars. And then I came on August 15th. President of the United States basically says, you're no longer going to get the gold, and we're not going to do that. I walk clerking on the floor of the exchange. I figured, wow, what a crisis. We're going to be down a lot. Stock market was up a lot. I didn't know what a currency devaluation was, but they happened many times. The 70s and so on, along those lines, were things that happened in my lifetime. And I got in a habit of, every time I would make a decision, particularly painful decisions, that was my cue that I need to do more research. Every time I would, I have an expression, pain plus reflection equals progress. So I started, if I have a painful experience, when I calm myself down, I would say, what can I learn? And I would go back and I would study that. And then I would take that learning and I would write down a principle. I wrote it down. And by the way, I would recommend that you do that. When pain plus reflection, you're going to learn mostly through your pains. And then you reflect well, learn the lessons, take in from others, and do your research. And I would then write that down. And so I would do that for everything, all the decision making that I did. So I started Bridgewater, and as mentioned, out of a 2-bedroom apartment, and I grow and I encounter things. So I did basically 2 jobs, the investing job and the running the business as an entrepreneur job. And for all those things, I accumulated a bunch of principles. And what I learned is that everything in life happens over and over again for the same reasons, pretty much. Slightly different, but by and large for the same reasons. And then for that reason, I knew that I needed to understand things that happened in my lifetime and the mechanics behind it. And that led me to not only experience a lot of debt crisis, because I've been doing this for about 50 years, and in many different places there were all sorts of debt crises. I went through 4 major ones in the United States, and I'm not talking recessions, I'm talking major ones. But in all these countries, emerging markets, Latin American one, I went through a bunch, and I knew that I also needed to study those that were happened before, like the Great Depression or Germany's Weimar Republic and so on, to get a frame of reference. Because how would I know that it wouldn't happen again? And I needed to understand the mechanics. So I did that. And that was one of the reasons, that was the main reason that we anticipated the financial crisis in 2007. We anticipated 2008 financial crisis. And that brought me in contact with policymakers and also Tim Geithner. And Tim Geithner, Hank Paulson, Ben Bernanke, and I do this, by the way, with others in other countries when, similarly. But in any case, Tim had this compilation of research about all these crises and how I think the same thing happens over and over again. And then Tim, coming in the financial crisis, and Hank Paulson and Ben Bernanke asked me to make a book about it so that it would be captured 2008 financial crisis. That's the book that you're given. And again, it's just that the same thing happens over and over again. So the way that when I don't know about something, the way I do it is I study all the times that thing happened. Let's say, for example, populism. I wasn't used to populism being a big thing in developed worlds. So then I found all the cases of populism, and I wanted to read them all and then come up with a notion of what is an archetypical case. What does the typical one look like? And then by knowing what the typical one looks like, I get that clear in my mind. The same way a doctor who gets to see a lot of different cases starts to figure, okay, well, here's how a typical one happens. And then from there, then you start to study the differences of why is this one different from that one, and then you have a frame of reference. So that's what I did, and that's what I do with everything that I'm studying. I want to look at all of them, and I want to understand how the archetypical and the linkages on that. And that's what I did with the debt crisis. So the book that's there has a brief beginning that just says how do these things work? The archetypical, I think it's like 60 pages. It won't take you long. And then behind that is three major ones looked at in depth: the Great Depression, then the inflationary depression of Germany's Weimar Republic, and then the 2008 financial crisis, looked at in real depth. So you can read the stories of those. And then behind that is a brief review of all those that happened in the last 100 years, which is, there have been 48 cases. And they basically all happen pretty much in the same way, but just with variations. Like a disease might evolve in different ways, but it has variations to it. So, okay, that's a big, long-winded introduction. But so that's what I want to give you a sense of, take you through the mechanics of that. So that's what I'll do. Okay, so I first want to give you a big picture template of, like, how do I look at economics? What is that? And this is a template. And by the way, if you want to take pictures of it or anything, you're welcome to do that. There's nothing proprietary here. But I want to say, just to distill it down and make it clear, I think that there are four big forces that determine what an economy is like. And those are productivity, short-term debt cycle, long-term debt cycle, and politics. So, but what I mean by productivity, living standards over a period of time rise because of output per man hour worked. And that basically comes from inventiveness. Creativity produces better ways of doing things, and that raises living standards over a period of time. And that evolves. It isn't very cyclical. It's not like you come up a great way to do something that you're going to forget that great way of doing something. So it evolves over a period of time. Maybe it grows at 1%. Maybe it goes at 2%. And there are certain things that determine how that operates, like your education. Produce a great education, produce a motivation for digging into things and doing things better, and you'll get productivity. It evolves. But we don't see, but the movements that we see in the economies are much more volatile than that. And so think about this productivity evolution, and then two big debt cycles that happen that cause the variations around that cycle. And those are the things that we experience. Because think of it this way. There's debt and there's credit. And they are the fuels of demand. So if you stimulate money and credit, then people could go out and spend more, and they could spend more on goods, services, and financial assets, and things go up. And then if you want to slow that down, you change the prices or the availability of money and credit, and then that slows it down. So central banks have this capacity to do that, and then we go into debt cycles, and debt cycles debt is naturally cyclical, because when you lend money, that gives buying power, and at that beginning you can go out and, if you're lent money and you could have a great party, you can go out and have a great party on borrowed money, but then the day comes back that you have to pay back, and so you can spend more than you earn when you acquire debt, and then you have to spend less than you earn when you're paying back debt. So there's a debt cycle, and by nature it's largely cyclical, and we're used to those debt cycles because they are, the recessions, the expansions, and the bull markets and bear markets, and they come along, and they're typically something like 8 years long, give or take a few years, depending on if the economy is weaker than expected, inflation's lower than expected, then central banks push a button, and they do this thing that then kind of perks everything up, and then you run into capacity constraints, and then higher levels of inflation, and then they say, I want to slow it down, and then they tighten. And that's the cycle, and we're pretty used to that cycle. These cycles then accumulate into a longer-term debt cycle, because if it was so easy to improve living standards, like just you increase the amount of borrowing and credit, we'd always do that. And there's a strong bias for up. If you look at history, monetary policies and so on, there's a big desire for up. And up is the development of those credit, and it adds up to a long-term debt cycle. And it starts when you don't have much debt, and you don't have much constraints in debt, and it ends when you have a lot of debt, and the capacities for that monetary policy to become stimulative become limited. So very classically, it ends when you hit zero interest rates. Let's say you have a lot of debt and you hit zero interest rates. That's on the downside, that's an impediment, right? Because you can't, the usual monetary policy of I lower interest rates and it perks up is not going to work when you hit zero and you have a debt crisis. So that happened 1929 to 32, and that happened 2008 and 2009, the debt crisis, zero interest rates. And then there's a classic way of dealing with that, which is the central bank then prints money and buys financial assets. We now call that quantitative easing. And that has its own effects. And those effects in the long-term debt cycle mean that the purchases of financial assets, printing money and purchases of financial assets, then cause financial asset prices to rise. And then what happens with that is that financial asset prices rise, the economy picks up, the markets pick up. Like today, when we see everything, the world is awash with liquidity. The financial markets are awash with liquidity, and everybody's competing, and that causes interest rates to go down, causes more leveraging it up, and it also increases the wealth gap. It increases the wealth gap because those with financial assets benefit relative to those who don't have financial assets. And in that longer-term debt cycle, then that wealth gap factor is an important factor in politics and the way things transpire. So we have the long-term debt cycle, but you also have the political issue. Politics matter. Politics matter. The big thing about politics is, most importantly, is a wealth gap, arguing about how you should divide the pie and make the pie. So that's the difference between left and right. When it gets more extreme, it's populism. So it's populism of the left and populism of the right. And typically later in cycles, then in these longer term cycles, simultaneously, you have greater populism on the left and populism on the right, such as what we have now, because we have not only a wealth gap, an opportunity gap, and so that tends to go together. And then there's internal politics that we're experiencing, and then external politics, in other words, world affairs. And so quite often you have a cycle where there's a rising power challenging an existing power, and then you have a geopolitical thing going on, and that happens at the same time. So just again to give you a sense of that, I think that there are three very important things that are happening now that are intertwined, and they are the most important things, and they repeat in cycles. The last time was the 1930s, but we know that there is a very big wealth opportunity gap, political gap issue going on now that is not the same as it was in the recent past. And I'll show you some charts pertaining to that. So that is an issue, and that becomes greater polarity. That's not just an American thing. That's a worldwide thing. The second is that we don't have the same capacity of monetary policy. We are late in the cycle in terms of, well, you can't get an economy going the same way where you are stimulative. And what does that mean? Central banks buy more financial assets, and those with financial assets do real well in relationship to others. And that it worsens the wealth gap issue. And of course, there are other things that enter into that, like technology plays an important role in not only advancing productivity in a sense, because we have discoveries, but it also has the effect of also replacing people in different ways. And so that widens the wealth gap, but technology improves productivity, but it doesn't improve the outcomes for everybody in the same sort of way, and it creates that polarity. So we have politics entering into it. So as I look at those levers, I then say that there are three equilibriums that I look at. If these are out of equilibrium, I sort of say, where am I in the cycle? And one is that debt growth is in line with the income growth that is required to service the debt. I'm always looking, okay, you have to pay the debt back, and what is the income growth? So a good investment is anything that is going to produce, good economic investment, is anything that is going to produce a return that produces cash flows and income that is greater than the debt service costs. And by the way, I believe that's true for anything. I think like education, for example, is a great investment. It may not be calculated. When people are thinking of educational budgets, they think of how I'm spending, and I think that's a shame. Where if you take a look at the return on investment for good education, and the literal economic return on investment, it's beneficial. So what I mean is I'm always looking at the pro forma financial. When in 2007, and we were doing the analysis of what was going to happen, I did the pro forma financial statements, and I could see that debts were coming due, and there was going to be a rollover, and they had to borrow more money. And just from doing those pro forma financial statements, I could see that we were likely to have a debt problem. And then when debt problems happen, they produce a cycle, because everything that everybody thinks is a great asset all of a sudden isn't a great asset, and then the stampede starts working in the opposite direction. So debt growth in line with economic growth, I look at that as an equilibrium. The second is the economic capacity utilization neither too high or too low. What I mean is this: if you have an economy that's depressed, unsustainably depressed, it will correct itself. It may correct itself by changing the politics. It may correct itself by monetary policy. It may correct itself because then there's a collapse in capacity. But economically, that has to be in balance. And it can't be too high, because if it's too high, then it produces inflation and stresses and so on. So when running that, nobody wants it too hot or too cold. So that's a factor. And then the third thing that I keep an eye on is the capital markets pricing as it relates to those things. And so number 3 are the projected returns of equities, that they have to be above the projected returns of bonds, which are above the projected returns by cash by an appropriate risk premium. That may sound a little complicated to you, but the most basic thing is central banks put cash on deposit. And capitalism works where those who have better ideas borrow that cash and take that and to put it into investments that have higher returns. And also, cash is considered a safe investment. And it's not so safe because if you look at inflation, it may not be so safe. But because of that, it's not volatile. There's a certain preference to holding cash, and so you need a risk premium to take the volatility. And for those reasons, if you have a situation where cash does not have a lower expected return than bonds, okay, and we could look at the yield curve, the relationship between that as an indicator, we're in a position where that's problematic. And if we don't have a return for equities, which is above the expected return for bonds, then you don't have that risk premium. And so I'm looking at those risk premiums because the way the system works is through central bank policy, particularly monetary policy, it is the means of changing that relationship that turns on the gas or puts on the brakes by central banks. So then I come down to what are the 2 levers? Okay, 2 levers are monetary policy and fiscal policy. And so how does that work? Okay, when you have a tightening of monetary policy, there's the changing of the cash rate and the cash availability relative to the bond yield and relative to the stock yield. So you see that starts to shift, and that changes the relative preference of those asset classes relative to each other, and that puts on the brakes or stimulates the brakes. And of course, fiscal policy is the spending of money. Central banks can produce the amount of money and amount of credit in the economy, but the central government can determine how that money's spent in the form of what taxes are, what types of spending programs exist. They have to operate together in that way because the central government doesn't produce its own money. So like if you take a state and you have a state of Connecticut doesn't produce any money itself, it's constrained because it can't print the money. Central bank can print the money and change that. And so what you have is a perpetual motion machine that is taking place. So when I look at those types of things, I think, well, where am I in relationship to each one of those? And by knowing where I am, I pretty much know what's going to come next. So, is debt growth in line of income growth that's required? Where are we in the economic cycle? Where are the projected returns and so on? Anyway, I'm going to go quickly here to give you an idea. So how do I think about credit and debt? 3 main points I want to convey. You can have both too little creation of credit and debt and too much creation of debt. And what I mean by that, people always think it's better to have less credit growth. But the key is whether it's a good investment. So too little credit or debt growth can create as bad or worse economic problems as having too much. The costs come in foregone opportunities. So there's an opportunity cost to being able to have that. For example, Russia has very little debt growth and that way, and they have very little development. The best thing to do is get that return on investment. The second is what matters most is whether borrowing generates sufficient income to service the debt. And I should say that that's important, but even there, it's not the end of the world if you have it in your own currency, which brings me to the third point. Debt crises can be managed well if the debt is denominated in a currency of a country. In other words, the real problems get in when you have foreign debt and you don't have the printing press. It gives you a lot of leeway if you've got the legal system and you can also produce money to service that debt, because debt is a promise to deliver money, and when you can fiddle around with that, you have a lot of leeway. So debt crises can be managed well if the debt is denominated in a currency a country controls. And second, if policymakers know how to manage one well and have the authority that they can do so. In other words, every debt crisis in which there's your own, if you have that ability to manage your monetary policy, can produce a type of restructuring in which you can get past it. I'm not saying it's going to be painless, but you can have a restructuring and then it passes. So if you look at all the debt crises, they've lasted a relatively limited amount of time. I mean, like a bad one lasts 2 or 3 years. And they are big deal crises during that period of time. But somehow we got past them all. And the way they got past them all was to do the restructuring. So you could do that, like China's right now in the process of doing restructuring, but you don't have to wait for a debt crisis. You can do it preemptively. You can deal with it. And so what I wanted to do here is take you through the various parts of that cycle. So I described what a typical cycle is like, and I broke it up into 8 parts. The early phase of the cycle, where debt growth is good. Then you get into a bubble phase. Then you create the top. Then you create the movement down. I'll call that the depression. It could be a severe recession, but it's a depression. Particularly, you get into special ones when central bank monetary policy can't be stimulated because you have the zero interest rates and the limitations to that. And then you go into a deleveraging. And there's such a thing as a beautiful deleveraging. I described it as a beautiful deleveraging because it's a beautiful way to restructure and get that behind you. And although we think of a deleveraging or as a depression, that kind of thing, you think of deleveraging, but it can be done beautifully. And then you have normalization and you end that kind of cycle. So I want to take the first phase is healthy debt growth, right? In other words, debt's rising, debt's and gets return on investment, and then that's good. And normally what happens in a cycle is it comes from first your terrible period, the really painful period, and everybody is scared and so on. And then central banks have got to push credit and whatever, and then they go through the process of changing the cost of interest rates, the yield curve, I gave the example, lower the interest rates, put liquidity out and get that thing going, and even backing things up, and then you begin, and then we'll get to the second phase, which is sort of the bubble phase. And that bubble phase comes about when everybody is extrapolating the past, and they say, oh, things are going to be better, and I'm missing the boat, and all the ideas of why borrowing at an effective rate is a good thing. That borrowing could be, let's say, people buying the houses because housing prices are going up, and you don't own a home, and okay, what are you going to do with your rentals or whatever it may end up being? It could be the tech bubble in 2000. In other words, there's the new technologies of tech, and we're going to buy those stocks, and we're going to borrow money to buy those stocks, and so on, because you're being left out. Or it could be, maybe, who knows, is it a bubble now? So, but you can see these elements exist in the bubble phase. These are the bubble phase. Prices are high relative to traditional measures. I won't embellish quite on each one of those. Maybe I could take it in your Q&A, but I want to give them to you quickly. Prices are high relative to traditional measures. Prices are discounting rapid future appreciation from these highs. What I mean by that is you could look at market pricing and deduce from market pricing the picture that is being painted of what the future looks like. In other words, if I look at the relation between stocks and bond yields, there's an implied growth rate. And if I look at the relationship between inflation index bonds and nominal bonds, I can calculate what the market is discounting in the form of future inflation rate. And so there's a picture of the future. And if the future is different than in that picture, that will determine the returns of asset classes. And so at times, at tops, what you tend to see is, here it is late in a cycle, and there's been quite a lot of debt growth, and you start to reach your limits, and yet the market is extrapolating or priced for an acceleration to take place. But, I mean, how's an acceleration going to take place if you're later in your limits? So that's what I mean by the second. There is more broad bullish sentiment. In other words, you're walking around and everybody says, oh, this is great and it's going to go up. Then there are purchases financed by high leverage. So that's apparent, buy on borrowed money, buy stocks on borrowed money, buy whatever the asset is, buy homes or whatever it is. And then sometimes buyers have exceptionally extended forward purchases. In other words, built-in inventory. Because they're worried it's going to go up, I have a good inventory. Or contracted for supplies because they work up. Or maybe buy an apartment to speculate that the price of the apartments are going to go up. And people in general are buying those things in that particular appreciation. And then in addition, that there are new buyers who come in. They never used to do it, but now they're attracted to it because it's a hot market. And so you see them coming in. The classic example of the tulip mania. Okay, you're coming in, I need to have tulips, and oh, it's a great thing to have. And you see that. And then you see a stimulative monetary policy that is going to inflate the bubble. And so when you see these things simultaneously, you'll see a lot of those. You can almost have that checklist, and you could check off those things. And when you start to see that, that becomes largely unsustainable. So here is this. These charts are just the averages of various items in these various 48 cases. So the first chart shows the equity prices, and it shows so the red box. It takes it through the cycle. The red box, which I'll divert your attention to, is showing what's happening in equity prices, that cycle. And then it shows also debt and debt service payments, and you could see that rising. And then what you could start to see here is in that bubble phase, this chart shows changes in debts as a percentage of GDP, and changes in debt service changes in debt minus the change in GDP growth. So in other words, the rise in debt relative to GDP. And so you could see, while you look at that, that red line is in the vicinity of 20%. In other words, debt is growing at a very accelerated pace. And it's rising, the change in debt minus GDP is rising still at something like a 10% pace. And so you could start to see these bubbles emerging. I see it in all different countries when you see that kind of very accelerated pace of debt growth, like it's very difficult to imagine. And then just below it, I'm showing the short-term interest rate, and you could see that there's not much tightening of monetary policy during that period to slow that rate of debt growth. Okay? Of course, a number of things are happening that I listed that long list, so I'm not going to go through them all. But then we come to the next phase, which is the top. And the top of the phase is then the tightening of monetary policy. So I'm showing that, in the red boxes there. And you could see then interest rates rising, and then interest rates, short-term rates rising relative to longer-term rates, reflecting the tightening of the monetary policy, but also it shows it changes incentives. Because if you have a high cash rate relative to your bond yield or expected return, then why not hold cash? And when you don't hold cash, then what you're holding is you're taking money out of lending, and you're holding cash instead of lending, and that has the effect of slowing things down. So that's the classic. And then we come to then the reaction, the dynamic, which I'll call the depression phase. And in that depression phase, things start to change. Debt service payments become high because the interest rates went up and credit availability isn't much, and you have a lot of debt, so they start to become squeezed, and then behavior starts to change. Asset prices change because with tight money and higher interest rates, the prices of assets should go down. And you raise interest rates, and that means not only are those shorter interest rates competitive, but it means that the present value effect, in other words, the interest rate that you're discounting future cash flows with, is then higher. So that means the present value of those assets goes down, and you have that downward, and then things start happening. So you have entities that are now having problem paying their debt, the higher debt service and so on. Asset prices are falling. So those who bet on higher asset prices are now starting to lose money. And okay, they get squeezed. And then banks have problems. The cash flows, because not only do you have a situation where those assets are falling, but also you have perhaps people who will move their money out of banks, and that bank money's lent and so on. So you have a self-reinforcing downward cycle that has to be reversed by changes in policy. Okay, so then if it's not just a normal recession, a recession can normally be handled by lower interest rates, increase the availability of money and credit, and then things pick up. It's almost like a central bank could hit a button and go, and it reflates. But if you have a structural problem like 2008, where you have zero interest rates, can't lower interest rates anymore, and so on, then there are four main levers that you have to do a deleveraging or a restructuring. And there are four paths. And we see these four paths. And we see in all these cycles, they go down the four paths. First, they go to austerity. They say, ooh, we have too much debt. And because we have too much debt, what we have to do is cut the debt and cut the payment. But the problem is that one man's debts are another man's assets. And, lending is required. And so you find that austerity doesn't work, because even though it's true you've got too much debt, the cutting back on the debt means the cutting back on expenditures. So you start with austerity, but austerity doesn't work. And the second is defaults or restructuring. And the problem with defaults, as I say, is one man's debt is another man's assets. So when you write that down, you're taking assets off the individual's balance sheet or the bank's balance sheet, and as that all those assets were collateral for credit and so on, you reduce the value, people get broke and their entities get broke, and that's not good enough. Then essentially there is the printing of money to stop the bleeding and to stimulate the economy. I would say the first two of these, I'm not saying they shouldn't be done. They should be done in balance. The first two of these, austerity and debt restructuring, are by their very nature deflationary, right? So they're going to cause economy to be weaker and inflation to fall. The next one is inflationary. In other words, when I say printing of money, taking onto the balance sheet of the central bank those purchases and going out there and making the purchases of assets. They may be targeted. They may be achieved through guarantees, like in the last 2008 financial crisis, where we went to things like, do you guarantee money market funds? Do you guarantee General Electric's commercial paper? These types of guarantees or actually printing of money, it could be a guarantee can work just as well as a actual purchase. What I mean purchase is the Fed or the central bank buys that financial asset, buys a particular financial asset. But in any case, what they do is they do print that money. They go buy financial assets and they take them onto their balance sheet, and then they start to control it well. And if that's done well in a way where it's done in balance with the austerity and the debt restructuring, then you have a process in which you can restructure the debt and then begin again. And so those are the three. Or there's, of course, redistributing the wealth, because redistributing the wealth can have an effect that if the debtor is in a bind and you get money from someone else and you help them make the payments, that's a possibility. That's a possibility too. So a beautiful deleveraging is when that's done very well. Okay, I want to distinguish then between inflationary depressions and related to currency crises, because I think there are deflationary depressions and there are inflationary depressions. And again, the big thing is what's your debt denominated in, because that gives you the flexibility if you have the printing presses. So countries with the worst debt problems, a lot of debt denominated in a foreign currency, and a high dependence on foreign capital typically have significant currency weaknesses. The currency weaknesses is what causes their inflation and has a capital flow, because they don't have the ability to exercise the beautiful deleveraging in the way that I described. And so when I look at it and I'm saying, okay, how's this debt crisis going to play out? I have my checklist here and saying, does this apply? Do these things apply? And then if these things apply, then I think it's more likely to be an inflationary contraction. And so here they are. They don't have a reserve currency. They have low foreign exchange reserves. They have a large foreign debt. They have a large and increasing budget and or current account deficit. They keep the deficits, and they have to monetize that. They have negative real rates. Interest rates are low in relationship to inflation. So what they're trying to do is take that which is their domestic debt, and they're trying to monetize it. And then they have a history of high inflation and negative total returns for their currency, because that's the way they run their monetary policies. So now I want to bring you up to speed in this and just show you again some of the parallels. This chart shows, top chart shows the debt, private sector debt relative to GDP, and so there you go, and that goes back to 1900. And then below that, I show both interest rates and the central bank's printing of money. So what you see is 1928, 29, classic high debt. You see the blue line, interest rates hit zero. You see the red line shows central bank prints money and buys financial assets. And so you could see that that also happened in 2008 and 9, a high debt burden. You go down, the blue line hits zero, and then the large printing of financial assets. And you can see that that's the only two times that that's happened in that century, because it is the same dynamic which reflects being late in the long-term debt cycle. The absence of the ability of monetary policy to operate in the same way. I say there are three types of monetary policy, what I call monetary policy 1, 2, and 3. Monetary policy 1 is largely interest rates. Monetary policy 2 is largely print money and buy financial assets. That becomes less and less effective, and then you get into what we call a liquidity trap, which is that you buy the financial assets and that's great for all the people who have the financial assets, except they're all competing for financial assets, and as a result, now all those financial assets will have low returns, but they don't stimulate the economy in the same way, and that has and so you have what's called a liquidity trap, and that means that you have to have in some manner a coordination between fiscal and monetary policy to be able to shift. Okay, so now let's take populism. Okay, and this cycle. So these two, the top chart shows the wealth gap, and I don't know if I have the income gap on the other. No, I probably should have shown. Anyway, the wealth gap and the income gap are each the highest levels since also the 30s. And the chart below that is an index that we created of populism, so that what you can see is we have a larger wealth gap and a larger income gap than has existed since the 30s. If I showed you the income gap, the top 0.1% of the population's income is equal about to the bottom 90% combined. So that type of magnitude of gap has not existed since the 30s. Monetary policy is in a somewhat similar position. And as a result, we're seeing this populism, in other words, greater extreme of the left and the right. This is a world index that we put it about different populism, but in other words, people are getting more angry at each other and things are getting more extreme. This is reflecting the political polarity that exists. The red represent Republicans in the House and in the Senate, and the blue represents Democrats. This chart goes back to 1900, and it shows both the amount of, in economic measures, the amount of how conservative or liberal they are. And what you can see is that the Republicans are more economically conservative. The Democrats are more economically liberal than they have been in a long time, going back about to 1900. And the chart below that shows voting according to party lines. In other words, are they working things out because they're collaborating and will go across parties? And you could see that that's the highest since about the turn of the century. Now, all I'm just saying is there's a lot of political polarity that's dealing with that. Okay, now I just want to, I'm about to end, so thank you for your patience. Also, then, as I said, there are three main things that are consistent with that, which is three main things. Internal conflict having to do with the wealth issue, wealth and opportunity issue. Second one is monetary policy and where we are in the economic cycle. And the third one is the rising of an external power, world power, challenging the existence, the power of an existing world power. Graham Allison at Harvard wrote a book about the Thucydides trap, the idea of when that happens, there's usually a conflict. There's conflict. So that's happened in the last 500 years, 16 times, 12 times there's conflict, and there is a nature of conflict. As a matter of fact, from wars to peaces, period of war and period of peace, a period of war is a fighting for power, and who wins the war. It is then followed by a period of peace because no one wants to fight the world power. So like in the United States, World War II, the reason that it won the war, the United States had 80% of the world's gold, and so you came into a world order that was the United States world order, and that meant that that's why the United Nations is in New York, the World Bank and the IMF are in Washington, D.C., and the currency, as the reserve currency, is the U.S. dollar. And then you have a period of peace because nobody wants to fight that. Then you go through a cycle where then you have that particular conflict. This is an average measure going back to 1500 of power. It's a measure. I don't know if I showed I showed the components of it here in terms of the cycles, but this shows the rises and declines of empires by 6 measures, and I'll show you. It's 7 measures: economics, technology and competitiveness, the amount of economic output, the share of world trade, the size of the military, the size of the financial center, and whether it has a reserve currency. This chart is the average of those prior charts to give an average measure of power. And so you can see over that 500-year period, the ebbs and flows of the major countries' power in the world measured by the average of those 2 things. So the blue line is the United States, the red line is China. So you can see the rise of across those measures. You also could see, if you go back, that China, through that period, and if I took it back another 500 years or more, always has been like number 1 or 2 in the world. And then you see that really come in around 1800, you see that big decline. So we have a situation where we do have the rising power challenging existing power. There are 4 types of conflict that we're having. We're having a trade conflict, we'll call it a trade war. You have a technology conflict, so we'll call that a technology war. You have a geopolitical conflict, and then we could have a capital conflict. So those are the things that are going on. I'm sure I used up more than my allotted time, so I think I'll stop here and then take whatever questions you have. Thank you.